Yo, you ever wonder how regular people end up owning apartment buildings? Like, not millionaires, just folks with a plan. It's not magic. It's called multifamily property financing. And once you understand how it works, you can turn rent payments into equity and equity into a legacy. So here's the deal. Multifamily property financing is just using someone else's money, usually a bank, to buy a building with more than one unit. That could be a duplex, a triplex, or even 20-unit apartment complex. Instead of just hoping your 9 to 5 saves you, this is about using leverage smartly. Now, here's where it gets real. If the property has 2 to 4 units, it's considered residential. You can use loans like FHA, VA, and sometimes get in with just about 3.5 down, especially if you live in one unit. Now, that's the move. That's called house hacking. But if the building has 5 units or more, now we're in commercial territory. That means banks aren't just looking at you, they're looking at what the building can do, right? So they're asking, how much income does this property bring in every month? Because at the end of the day, the property itself has to be able to pay that loan back, okay? So it's not just you. Now let's run through some of the most common loan types real quick. All right, y'all ready? You got FHA loans, which is great for first timers, but you got to live there. Okay? Conventional loans, it's more flexible, but they want to see stronger credit. Portfolio loans, right? Offered by small banks that keep the loan in-house. These can be clutch if you've got a creative deal. Now, agency loans, that's your Fannie Mae and your Freddie Mac stuff, mostly for bigger properties. And then you got DHCR loans. Those are dope for investors who want the loan to be based on the building's income, not their personal tax returns. Got it? So most of these loans come with terms, of course. So you got 20 to 30 years and interest rates around 5 to 8%, depending on your credit, property, and the lender. All right? So what do lenders actually want to see? If it's a smaller residential deal, they're checking your credit, okay? They want to see your income, your debt to income ratio, but for commercial stuff, it's all about the numbers because, well, behind the building, your net operating income, your cap rate, your DSCR, they don't care about your job. They care if the building makes money on its own. So the bottom line, multifamily financing gives you control. You can lock in an income-producing asset with a low down payment, let your tenants pay off the loan, and build wealth over time.